Hey traders, this is Blake Morrow with Traders Summit, and it's Friday. Oh, of course, I have Mr. Jim Welsh here because he's going to figure out, is this the turn that we're seeing in equities? I mean, we're actually starting to see the equity markets roll over a little bit as we are heading into the end of the week. So, Jim, welcome and good to see you.
Like a bad penny. I just keep coming back every Friday, man.
That is an old saying. When are we going to get rid of pennies? When are pennies going to become non-existent?
Sometime in our lifetime, I don't know, you would think soon. I
You would
mean, again,
think.
it comes down to when are they going to get rid of the nickels then and dimes? It's almost like it'll be an avalanche, Blake.
Yeah.
The government has control over every single penny that's moved because everything's done digitally,
Yeah.
but there will be no abuse of power.
None, zero. Speaking
Uh,
of abuse of power, it feels like this market has lost a little bit of its abuse of power to the upside as early as the
yeah.
last couple of days. The last couple of days, we've seen the equity markets roll off a little bit, and it seemed to kick off right around the CPI PPI data. Do you think that's what turned the market, or is it just maybe just being a little bit more overbought and needs to pull back?
All of the above. I mean, when we spoke last week, I noted that the S&P was pushing up against a trend line that had connected prior peaks. The internals were not great, and that suggested that at a minimum, because a week ago, remember, everybody was still caught up in the post-election euphoria. Uh, to me, it suggested a 2 to 3% pullback. So far, that's what we're seeing. Then, what gave impetus? Well, two things, the CPI. And on Monday, I wrote about this in my weekly technical review that we were likely to see the CPI tick up by a tenth. And it did 2/10 on the headline due to rounding. And then the other interesting thing, Blake, yesterday, which almost seemed to have more impact than the CPI, is Chair Powell gave a speech. And the crazy thing from my perspective is when he has a press conference after an FOMC meeting like he did last Thursday, I get the transcript. So I read his statement, his opening statement, and then I get everything that he says in response to various questions. And the theme that he struck last week and yesterday were virtually identical. That inflation is down, labor market tightness is easing. As a result, there's balance between those two mandates that the Fed has. The economy continues to be strong. And as a result, we really don't need to be in a rush to cut rates. Now, again, Wall Street, after that SEP meeting when they did 50, Wall Street was like, oh man, they're going to go another 50. They're going to go 25 every single meeting next year. Now that the projections at September said they're going to have two more cuts, November, December, and one cut every other meeting next week, or pardon me, next year. So my point is Wall Street's been off sides, as they usually are, in anticipating more cutting by the Fed. And so I think all this stuff has come together as like, maybe the Fed won't be cutting rates so aggressively next week. And as a result of all this, we've seen Treasury yields, rebound. They had a pretty good drop at the end of last week. They've recovered all of that. And I think it's collectively, all these things are coming together where people are like, maybe and the market's over, stretch, time for a pullback. So far, I think it's still within the context of an uptrend. The key thing that I'll be looking at is from the high we had last week, does the S&P trace out 5 waves as a decline? If it does, that will tell me that the correction will last longer and obviously be deeper, but we're not there yet.
Well, Jim, you're getting into some of the technicals. So before you
Yeah,
do that, let's just jump into the charts that you brought, and then we can get to that
yeah,
point. I
yeah.
know you're jumping ahead, and you're going to say just like I told you earlier. So let's go ahead and let's go ahead and
Yeah,
look at your charts that you're bringing up. The first one that you brought up is right here on the 10 year. Uh,
yes.
so what do you make of this, and what is this
Okay,
telling us?
so in the context of the charts that we're going to be talking about today, Blake, I think this could be one of the more consequential chats that we have. because we're going to look at bigger picture type stuff, and both from an economic standpoint, monetary policy, and then technically with the various markets. And one of the things, what this chart basically says and shows that, well, what's happened in the past to the 10-year yield when the Federal Reserve has lowered the funds rate? And what you can see is the gray is the range that have happened, range of outcomes. The dashed line that's kind of more brownish in the middle is the median. And what we can see, the green line is what's happened. So we saw that over the last 90 days going into mid-September, 10-year yield had come down. And then we can see how big of an increase that has taken place. So my point is, this is an outlier relative to other instances when the Fed cut the funds rate and what subsequently happened to the 10-year. So it's like, okay, we have this outlier. Why is it happening? And that's what we're going to talk about in the next two charts. This is the 5-year break even. And I track this pretty much every day because it's helpful in terms of understanding what's going on with the bond market. But also last Thursday during the press conference, Powell talked about this. So they pay a lot of attention to the 5 and 10-year. To me, the 10-year is so far out. It's like, okay, I'm not going to pay attention. The thing I would point out is when Treasury yields peaked last October, the 10-year was up around 5%. This break-even rate got just a little bit over 2.5%. And then when yields went up again into, I believe it was what, April? The 5 break even got to a little bit over, yeah, April, 2.5%. Well, the last few days we've been hovering around 2.43. So 2 points to make. First of all, from mid-September, you can see the big increase in inflation break evens. Because we got economic data that came in better than expected. Anticipation then that the Fed, because they were cutting rates, would be good for the economy and so forth. But my point is from a technical point, and then what does this mean for Treasury yields, is we're coming up to a point in place on the chart that is very important that it doesn't break out above. So if this break even closes above 260, I would look at that as being, okay, this is negative for Treasury yields. As it stands right now, we've gotten to just the area where one could expect the break evens to peak out and then decline. And from that high in April, you can see it declined into mid-September, and 10-year yields dropped significantly during that period of time. So this is one of the behind the scenes dynamics that needs to be watched in terms of, okay, if one is thinking that there's the possibility that we'll see Treasury yields come down, this has to be supportive. And, so we're at a critical juncture in my view.
All right. Well, the next chart you brought, since you said these two both matter, this is Economic Surprise Index. So tell us what we're looking at here.
Okay, on the top is the Economic Surprise Index, and we've talked about this off and on over the last, probably year. Basically, economists come up with forecasts of what they think retail sales, jobs, every economic data point under the sun, and they come up with forecasts. And when the recent forecasts have come in below expectations, economists, being human beings, start to lower their expectations for future data points. And lo and behold, it makes it easier for the data to come in better. Conversely, when the data has been coming in better for a while, as it has for the last 2 months, they start to increase their expectations and forecasts for future data points. So what we're showing here is the Economic Surprise Index on the top half. The bottom half is Treasury yields. I mean, the correlation is pretty unmistakable to me. So in April, when Treasury yields were peaking, then we saw the economic index decline. Well, that's because economists had raised their expectations for the economy, and then the data points started to come in underneath. We're at a point where you look off to earlier this year, up around plus 40. It's at 37 right now. that, all right, this is showing the early signs of potentially rolling over. Economists now are even more certain in more in aggregate raising expectations for the economy because of Trump winning and what they believe that is going to mean for the economy as far as reduction in regulations, some benefits in terms of taxes either being tax decreases being re-upped in terms of the tax plan that went into effect in 2017, comes up next year. The thing I would point out, Blake, is because the Republicans have the House, Senate, and White House, there's this expectation that they're going to be able to kind of steamroll various policies through and get bills passed very quickly. And I think there's two speed bumps on that. First of all, they're narrow. The margin is narrow. Okay, 53 in the Senate is a decent cushion. The House is very narrow. I think they're going to be up maybe 5 to 8 seats, something like that. What we have to understand is within the Republican ranks, there are some real deficit hawks, people who believe that we really need to get spending under control and start to shrink the budget deficit. So it's not going to
So
be
there's
the
some old school Republicans around, you think?
yes, yes.
Okay.
And are they going to, oh yeah, let's do this, more spending, a bigger deficit, who cares? So my
Sure.
point is he's going to face resistance within his own party. In terms of the Democrats, the progressive, far left wing of the Democrats have been driving that party since Biden took office. And one could say, obviously during Obama's, but especially the last 4 years with President Biden. Those people are not going to give up power within the Democratic Party easily. And one of the symptoms that we can see is they just kind of got run over in the election. But very few of them are acknowledging that, gee, just maybe it was our policies that caused the problem. Instead, they're pointing fingers like, the voters are stupid. Boy, are they going to regret their vote and so forth. So my point is, there's a hardcore reaction by a lot of Democrats to fight tooth and nail everything Trump wants. And so to me, I think the idea that the Republicans are going to be able to get all this legislation that's supposedly going to be really good for the economy through easily and quickly, I think is set up for disappointment. So, from a longer term standpoint, I think that's one of the issues that is going to change people's perceptions as they exist today.
All right. Well, yeah, it's going to be interesting to see how they can pass everything that, and push forward that agenda. So but
Yeah.
we still have two months before he even takes office. So, we'll see.
Yes. But we're going to see
Long
is that,
time.
Blake, we're already seeing a little bit of a symptom in terms of some of the nominations that he's made. I mean, there's some Republicans that are like, hey, man, I don't know about that one.
Yeah.
Oh, I don't know about that one,
Yeah.
And so my point is some of these nominations aren't going to get through. And, the Democrats, of course, are going to be against every single one of them, pretty much, other than maybe Rubio. That might start making people begin to think about this stuff like, whoa, maybe it won't be, 0 to 100 right away.
Right.
So,
Yeah,
yeah.
that's a great point. But when I mean these are nominations, when do the hearings start?
Well, technically, after he assumes office.
So I mean
So
so there's still
now he's
Jim, it's a lifetime away, literally in the
in terms
markets.
of markets.
Lifetime.
Now he's trying to fast track some of this stuff during, like between before he gets elected. There's, technically a way various presidents have been able to avoid non-cabinet type positions, I believe. They can kind of fast track some of this stuff. But again, I just think that the mindset of Democrats is to fight this guy tooth and nail. And some of the media may be a little bit less on board than they have been the last 4 years because places like CNN and MSNBC have seen a very significant drop in viewership. Now, some of that is people just being worn out, by the election. And I mean, I don't need to hear that anymore. But again, there's a backlash that has taken place for the media which I think will make them move a little bit more towards the middle and not so full-throated always against Trump 24/7. So again, all these changes I think are right now aren't being recognized by markets.
All right. Well, Jim, we got a few more charts to chew through. So
Yep.
this next one is continuing claims. So why did you bring up this chart?
Well, okay, so everybody's, hey, boy, the economy's super strong and blah, blah. Okay, all right. Well, what we've seen is this year, continuing claims have followed the seasonal track very, very closely. It's the number of weeks per year. So that's at the bottom axis. And we're comparing the dark blue line with 2018, 19, and 23. And you can see they followed it very, very closely. Well, what happened in all those other years is we saw a big increase in claims in the last 6 weeks of the year. Um, so my point is, why would I expect it not to behave that way? If it does, if we don't see a tick up in claims, then it would make me more believe, hey, this economy maybe is stronger than I think it is. But more likely, we're going to see claims tick up, Blake. And as they do, people who don't pay much attention to charts like this, which means basically almost everybody, um, when those claim numbers start to go up, potentially people are going, whoa, maybe the crack in the labor market is finally appearing. Well, if that does happen, all of a sudden, any questions about whether the Fed will cut in December, because now there are questions, well, maybe they won't cut in December. If we see claims start to tick up, that will go away. And I think that means it lays the groundwork for treasury yields to come down.
Oh
So,
boy, now we're talking. Okay, so you have I'm going to bring up your next chart here. Just give me 1 second as I have to pull it. I mean, we're going to start with the dollar because if you're saying treasury yields are going to come down, that also means that your dollar bearishness might come in. And look,
yeah,
I'm with you. And here's the dollar chart that you
yeah,
wanted to
yeah,
talk about.
yeah,
I'm with you. I'm actually I'm doing an event this weekend with a bunch of other traders, and it's a big event. And really, my
yeah,
my trade of next year is shorting the dollar. Not necessarily all dollars, but there's specifics to that.
that bias.
But but you know, based on what you just said, you think that economic data is going to weaken to a point where it's going to
Mhm.
really start to weigh on the dollar. And
Yeah,
but we're breaking out here. So technically we are breaking out.
yeah,
So
yeah.
tell us
Well, when
where
the
are we
dollar was
turns?
around 100, I thought it was going to rally. All right. Oh, great. It did. When it got up around 104, 4.5, it's like, okay, I think the rally's done. And then obviously what we've seen is this breakout above that trend line because of the election in large
Yes.
part. All right. So all of a sudden the pattern kind of changed. All right. Well, what the heck could be going on here? So let's go back to the far left. You see the 114.71. That was in a very important high. I was actually pretty bearish at that point in time, looking for a decline. I thought to 104.50. It dropped to 101 in change. So that's a 13 and a half point decline. We then began this choppy sideways pattern, Blake, which I think is close to being complete in the sense that the rally from 99.57 to 107.34 completed an A, B down, C up for wave A. We then from 107.34, A, B up to 105.52, and then C down to 100.16. That completed wave B. Now we're in wave C, and obviously this rally has all the characteristics of a wave C, very dynamic, persistent, all the rest. So based on the lengths of these moves, I come up with a couple targets, 107.93, 107.85, and at a minimum, it should get above the 107.34. So I think we're going to see near term some additional strength as this rally plays itself out. But what that implies, if this pattern analysis is correct, and the one before that we had talked about, hey, okay, we're going to get a rally. I never expected this, all right? But here we are. it implies that once a top is made, I would expect the dollar to decline 13.73 points. Why? Well, that's how much it dropped from 104.17 to the 101 low. And if it gets up to that 107.80 number or so, 1373, it gets you under 95. So this is the reason why, I have consistently said next year, I think the dollar is going below 95. The path of how we're gotten to where we are now changed. Didn't see that Trump and the Republicans would do as well as they have. The markets have reacted to that, but I don't think it changes the bigger picture. So yes, it implies the economy will slow, but more importantly, people have to remember Trump likes a weak dollar.
Yes.
Okay, it's just a question of when that is going to become more apparent. And I think obviously we're talking probably early next year, first quarter after he takes office. Um, as I noted last week, when Trump took office in January of 2017, the dollar index was 102. By February of 2018, 13 months later, it was 89. So again, he wants a lower dollar because that will spur exports, make America great again. Well, if our stuff is cheaper, more people will buy it, and that will, help the U.S. economy. So that's what's coming. In the meantime, we have to respect the trend that's in place. I think it has more to run in the near term, but from a bigger picture, this is the pattern that I think. The only thing changed, I was still looking for 95. I just didn't think we'd go above 107.34. I thought we'd peak below that and then get that decline. But so the bigger picture pattern hasn't changed. It was just the short-term pattern of when this top would form.
Just so everybody knows, Jim, I've been looking at 107 and a quarter, and the reason 107.20, it depends
Mhm.
how you draw it. It's a 50% retracement of that entire move. The
Yeah,
one on your screen that you're showing. So
right, right,
so
right.
there's that too. Hey,
Yeah,
the next chart is probably one that most people really want to pay attention to or see is what's happening in gold, because gold has been it's really pulling back, and I think we could see 2400 just because that's where the 200 DMA is at. Do you see
sure.
lower than that?
Well, in the last 2, 3 weeks, I've been pointing out, hey, things are setting up for a pullback, positioning, sentiment, RSI divergences, and so forth. But first, let's talk about the bigger picture here. From the low that we saw 18 months ago, whenever it was, I'm showing wave one, wave two. I think this top is wave three, big picture stuff. So we're in wave four. And after wave four, there should be a wave five that takes it to a higher high. All right.
So
So
wave four
that's
should be somewhere down here, and then wave five would be somewhere up here. Is that correct?
correct.
Okay.
Correct. So last week when we spoke, I said, okay, we've gotten this decline. It was 141 bucks, rallied to 127.08. That to me suggested 25.67 with those two legs being equal. So far, the low is 25.41. So my take here, Blake, is if this is wave four, well, how long did wave two last? Because wave four and wave two very often are close in terms of the amount of time. Well, wave two lasted 5 months. So if we say 5 months from October, then you're talking probably what, Marchish, somewhere, let's say early March. So what this implies to me is, we strike a bottom, we get a bounce, and then I think there's another leg down. And once we have this trading lows in place, let's say it's, whatever it is, and the decline is 200 points. Then you get a bounce up to 2,700 or some number. I would expect the next leg down would be somewhat equal. So if this leg finishes down over 200 points, then the math works out the same. Yes, that's my guess. Is short term things are getting compressed. We'll see, dollar pushes a little bit more. But I think there's so many people that are bullish gold that, yeah, did you peel some of them off? Absolutely. But I just think that the bullishness that is almost ingrained at this point in time, that people are going to be looking to buy this dip. And
Okay.
that's what gets us a bounce. And then if there is another leg down, that's when you really have changed sentiment from being crazy bullish as it was over the last 2, 3 weeks to far less, more, a lot less bullish.
Okay.
You have to burn
So
that off.
it's gold's moving from the far left to more center. Just kidding,
Kind of,
joking.
yeah, yeah, sentiment. I mean, you're
Uh,
not going to get people be extremely bearish, I don't think.
yeah.
But instead of having, like 75% of the people are bullish, maybe it pulls back to 45%, you know, or the RSI on a weekly pulls back to 40, instead of being at 70 or something. It just resets the table. And then that would allow gold to rally. And again, tying this together with Trump talking about a weaker dollar, and that might become more apparent as we do get out towards Marchish. That's when we could expect maybe more pronounced weakness in the dollar. Well, then that would tie in with potentially gold having completed a correction and then be set for another liftoff.
All right. Perfect. Okay. Well, the next chart you have is TLT, and don't worry, guys, we're
Yep.
getting close to the S&P. It's right after this one. What do you make of the market here? Because bonds continue to go down, TLT continues to
Yep.
go down, yields are rallying, but you think they're going to reverse.
Yeah, I do. And I've been early, in terms of expecting this. A number of reasons. The economy has proven more resilient than I expected. Obviously, Trump winning in people's expectations for more growth and potentially bigger deficits and so forth have all played a role. So again, this is like looking at this bigger picture. So if you look at the middle, that red five, that basically is going back to TLT topped at 179 in March of 2020. You had a big five-wave decline into the low last year. I was bullish October of last year looking for a rally. We got it to 100. And then I think, Blake, what's happened is it's done an A down, B up to the 101.54, and now we're in wave C. And once this wave C is complete, what it implies then, we're going to get a bigger, the blue C up toward above 101.64. Again, I keep going back to 105, 109 as being potential targets. And again, how would that happen? Well, the economy is definitely going to have to be weaker than it is today. And they're talking about cutting spending, with the Department of whatever, Doge, whatever. I can't
Doge,
remember. Doge.
Department of Economic,
No, it's
Government
G
Economic,
something. I don't know.
whatever it
Government
is. Okay,
excess.
but
I don't know.
anyway,
Whatever
I
it
know
is.
some of you are already finishing the sentence in your head. So,
Hey.
but
Yeah, yeah,
okay,
yeah.
continue on.
So my point is that maybe there's some other surprises. I think the main thing has to be the economy slower. We talked about it last week. At some point in time, might Israel go after Iran's nuclear stuff and oil installations, to really finish the job so that Iran doesn't have the money to fund terrorist groups? Obviously, that would cause oil prices to rise significantly. Yeah, will that be inflationary? Yeah, but it also would lead us definitely into a recession. Bonds would respond to that. So the chart pattern to me is setting up that we're coming up to a low, getting near that 87.34 is still a possibility based on this pattern. You could even take it out by a small amount. I think then you're still going to get the C wave rally that takes TLT up significantly. Now, what if I'm wrong? What if the ABC from the low last October to the 101.64 is all the correction against that huge decline? Then this would be wave one of the next declining wave. And what that implies is, all right, there's going to be a wave two retracement rally. So let's say TLT did get down to 87. That's about a 14-point decline, 50% retracement. would get you back up towards 94 to 96. So that's what I've been saying the last 3 weeks is, hey, we're going to get a bounce to 94, 96.
Yeah.
If I'm wrong about the bigger picture, if this is the pattern, then it's going to go much higher.
Jim, there's so many people that are bearish the bond market. You get people
Thank you.
saying things oh, what's his name? Just said they're
Druckenmiller,
uninvestable. That's
yeah, and Paul
all
Tudor
the
Jones.
macro
Hey,
guys
and
on social media. It's all uninvestable now. So,
yep, yep, yep. No, yeah, I'm glad you brought that up because that is obviously an important. This is the perfect environment, but we're going to need economic data to, start to surprise to the downside. Unemployment claims ticking up will be the first helpful benefit. So that's why I've put all these things together and then seeing the break evens start to come down. The term premium has jumped, I think, about 50 basis points. So 10 years up 80 basis points, half of it, or more than half, is term premium. In other words, what do people think they need to be paid for holding long-term bonds? So all these things have come together, Blake. I think we can see a reversal, but we're going to need the data to give it a big push.
all right. Well, the last chart you brought is what everybody wants to know. Is the stock market actually peaked? Whoa, sorry about that. That's me
Yeah,
getting
yeah,
a
yeah,
little
yeah.
crazy here.
Oh,
There you go.
okay,
Has the stock market peaked here, or is this done?
it's possible. And again, last week we talked about the breadth was weakening. So we had a new price high, but most of the breadth measures that I keep momentum wise were woefully negatively divergent. I said at a minimum, we'll get a 2 to 3% pullback. And so far, that's kind of about where we are. The AD line in my weekly technical review on Monday, I showed a chart of the advanced decline line. And my point is, if you go back to that low several months ago, you can see the 80 line, which is the bottom pattern or panel, and it just kept marching higher, higher, higher. And for the first time, we're seeing the AD line not participate. Uh, Historically, very important tops have occurred when you get an AD line divergence. In January of 22, for instance, the S&P made a higher high relative to November. The AD line was below. 2007, AD line or the S&P made a new all-time high in October. AD line diverged from where it had been in June. I can go back to 1929. So this divergence is important. And so to me, it raises the question of, well, maybe we've already seen the top. It's possible. As I said it before, we want to see a five-wave decline, ideally on a daily chart, from this recent high that we saw last week. That would add more credibility to at least a deeper correction. The other thing I'll point out is the numbers. From the low last October, you can see the blue numbers, 1, 2, 3, 4. And I think this is the bullish take here, is that in red, 1, 2, the high we saw last week was wave 3. This is a wave 4 pullback. And then it would be followed by one more rally to a higher high above 6,017. And if that happened and the AD line diverged even more so, Blake, then I would become really, really bearish and look for a very significant decline. Again, the risk here is that the economy is weaker than everyone presumes, especially with the Trump victory. And if that appears, and again, the patterns that we've reviewed, the dollar potentially making an important high between now and year end, bonds bottoming, treasury yields topping, in the not too distant future, and the S&P making a very important high. The technical, you can come up with a narrative that goes against the consensus right now. And that's why, to me, I mean, that's what I like to try to do is what's everybody thinking? Are there reasons to go against it? And what we reviewed today is, yes, there are reasons to go against it. But obviously we need more evidence, more fruition in terms of that narrative gaining strength. And that's when, if that narrative starts to gain strength, then all of a sudden what happens? Oh, wait a second. The economy's slowing. Maybe that's not going to be good for stocks. Oh, treasury bonds. Everybody hates them. Maybe I was wrong, you know. So the table's set. Um, but that to me is kind of the way things are set up at this point.
Well, table's set. Let's eat, Jim. Let's eat. It's time to chew.
Hey,
As your friend and mine, Dale Pinkert says, bears feast. No, bears feast on for Thanksgiving. Bulls celebrate Christmas. I don't know. I forget what he says.
you better go
he has
back and
sayings for everything.
ask the Axiom master, ask Dale what he means. I know, you know, bulls eat and bears eat and pigs get slaughtered. You know,
Yeah, I'd forget what it is, but
yeah,
also I do want to point out, since you know I'm a big Fibonacci person, the sell-off we had at the very end of summer in August in the S&P,
hmm yeah,
we came within 5 points of the 161% golden fib level this last week. So I mean, there's a lot of technical levels that are matching up here. Plus it's 6,000. I mean, it's a big
big
number for
round
people,
number.
right? It
Yeah, yeah,
is.
yeah, yeah. I mean,
Anyway,
again, it'd be perfect to go up one more time and have the technical stuff reinforce a top even more so.
don't be a
And
pig,
next week is
Jim.
Nvidia.
Don't be a
So
pig. Don't be a pig.
I'm not trying to be a pig. I just, you know, trying to, you know, take the tea leaves and make a good cup.
Hey, I appreciate you guiding us every week, and I'm sure everybody else does. And if you do, make sure you jump down and
Yep.
below and give Jim a big thumbs up, and subscribe to this channel because, excuse me, this is a very exclusive content here to Trader Summit. And then also, if you want to add things like I just told you guys about the fib level that I was looking at, if you have
Yeah.
things that you've been seeing you want to add, jump down in the comments below. I'm sure other traders would like to hear that as well. Jim, I want you to tell everybody how to get your most recent technical
Sure.
review.
Jim Welsh Macro at Gmail. I'm happy to send that. And you know, I think we're in for some big changes in the in coming months, Blake. And if half of what I'm talking about comes true, there'll be some great opportunities trading wise. And those who just like to think, well, market's just going to go up, um, it's going to be a far more challenging environment. And so I think what you do, you know, every single week with Trader Summit and is going to become even more invaluable to the people that tune in because nothing, you know, when markets are just going up and it's all rosy, no one thinks they need anybody, you know, in terms of you know, any additional advice. When markets get tough, that's when people realize, maybe I need to be talking to someone who is more knowledgeable, has more experience, and that's why I think next year you're going to have a great year.
Jim, I couldn't agree with you more. Sorry, I had to put myself
Just
off
don't
camera for
choke.
just a second. But I just want to say thank you so much for being with us each and every Friday. You very rarely miss a beat. So thank you very much, and have a great week. I'll see you next
You
week. We'll
too.
all see you
You
next
got
week.
it. Yeah, you got it, buddy. Take
Thanks,
care.
Jim. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.